You remember I spoke about four key factors that affects the market at every point in time. We have momentum, pattern, price, and time. And I spoke about this in my very first video on high probability strategies. If you missed it, kindly watch. So we are continuing the session. This is all part of a much bigger course on high probability outcomes when you're trading, at the same time facing minimal capital exposure. Right, so we are going to touch on the basics of Elliott waves. And Elliott waves was discovered by Ralph Nelson Elliott in the 1930s after observing the market for quite some time, but he was an accountant. And he made an observation on the market, okay, that the market behaves, even though people believe the market to behave in a random and chaotic manner, it actually, in fact, trades in a repetitive pattern. So the market's progression unfolds in waves, and the waves are patterns of directional movement. So the first thing I want to look at now is the 5-wave pattern. You're welcome to Boom and Crash Expert Advisor. I'm Danny Legend. So I'll quickly move to the drawing board. So we talk about the 5-wave pattern. Usually the wave goes this way. This is wave 1, and then we have a retracement, but this is not 100% retracement. Then we have another wave, then we have a retracement, then we have a wave again. So this is the end of wave 1. This is wave 1, wave 2, wave 3, wave 4, and wave 5, representing a 5-wave pattern. Now wave 1, wave 3, and wave 5, they show us the directional movements, okay, and they are separated. Wave 1, 2, 3 are separated by counter trend interruptions, which is wave 2 and wave 4. So I would indicate them with red. These ones are counter trend interruptions. They interrupt the directional movement. So the market is generally moving upward, but it's not going to move at that level or that distance in one sitting. It's going to be interrupted on the way by these patterns. Okay, it's always the case. So the two interruptions are needed for an overall directional movement to occur, but there are three consistent aspects to it. There are three consistent aspects to it. These are the tenets. Let me call them the tenets. Is that wave 2 never moves beyond the start of wave 1. So wave 2 will never move beyond the start. This is the start of wave 1. This is the start of wave 1. Wave 2 will never move beyond wave 1. That's the first tenet. The second is wave 3. This wave is never, wave 3 is never the shortest wave. Sorry. It's never the shortest wave. And it's usually the strongest of a trend. And this you remember a mastering price action course, that this was where the acceleration channel took place. So within the Elliott wave, this is usually the strongest of a trend. Then the third tenet is that wave 4 will never enter the price territory. Of wave 1. Right. So this is the price territory of wave 1. This area, this zone. Wave 4 will never move into this zone. If it moves into this zone, it has defied the whole 5-wave pattern. And then we have to look out for the new formation of an Elliott wave. Right. So there are two wave modes. The first wave mode is the motive mode, or the kind of wave that impels or drives the market. So those ones are the 1, the 3, and the 5. These are motive waves. And then we have the corrective waves, which are 4 and 2. Very simple. So the corrective waves involve partial retracement, in that the market moves this way and retraces, moves this way and retraces. So these retracements are corrective waves. But this 5-wave pattern is not complete, because as it stands, it's only representing the bullish aspect of the market. It's only showing us that the market is going what? Up. It's only bullish. So what is the complete cycle? Let's look at it. To look at a complete cycle, you have wave 1, wave 2, wave 3, wave 4, wave 5. Then we have wave A, wave B, and wave C. So in all, the complete cycle is actually an 8-wave pattern. Now we'll go to our chart to see where we can find even our 5-wave pattern. So there's the start. So let me just place first here. So we have 1, we have 2, we have 3, we have 4, we have 5, we have A, we have B, and we have C. So the corrective phase will be labeled by letters, and the motive phase will be labeled by numbers. So if you pick this wave 1, wave 3, and wave 5, realize they are impelling, they are bullish. But at this point in time, this is supposed to be our wave 1. When the market is becoming bearish, this is supposed to be our wave 1. It's supposed to be our wave 2 and wave 3, right? But because it's bullish and it's corrective, we are looking at this with labels of letters. Then we have wave C. So we'll go to the market, we'll look at step index and try to find our Elliott wave pattern. So you find out there is 5 and 3. There are 5 waves here, and there are 3 waves here. So this half is showing us 3 waves, 1, 2, 3 of the complete 8-wave pattern, and this side is showing us 5 waves. So 5 and 3. So why 5 and 3? Because according to the theory, that is the minimum requirement and the most effective method for achieving market fluctuations and progress in a linear movement. Okay, so let's go to our chart and see where we can find a 5-wave pattern. And let me add this, that at any point in time, the market is identified as being somewhere in the basic 5 pattern, because all other patterns are absorbed by it. I know it might be a little bit complex for you, but do bear with me. So let's go to our chart. I'll move to H1 on step index, and there's what you see. On step index H1, we can find our waves from here. Let me zoom out. I'm picking it from here. Okay, you find this. I'll turn off my rewrite. Then you find this wave 2. You see wave 1 even started from here. Wave 2 doesn't go beyond wave 1, doesn't go beyond the start of wave 1, and this is bearish. So when you see this, immediately you see that the second trend does not go beyond 1. Know that the Elliott wave pattern is starting to form. Then the third is the strongest, so you can always pick the strongest lane as your third wave. Then we have the fourth. Then what do we have? Because the fourth never enters the zone, the price territory, or the zone of wave 1, remember? And then we have the fifth wave. Okay, so from here, this is bearish. From here, after the 5-wave pattern, what should happen? The bullish should form, which would be a 3-wave pattern. Do you get the whole concept? So we could pick any time frame. This is M5. I can pick this as wave 1, and then wave 2 never goes beyond the start of wave 1, and then wave 3 is the strongest wave. You see this, and then you see this. I'm going to talk about this later. This is what we have for wave 3. Then wave 4 never enters the price territory of wave 1. And then what do we have here? Wave 5. So from here we should have another, you see that we should have a bullish forming. So we are going to have a bullish pattern form after the first 5 waves. So the last 5 waves ends here. What we just drew ends here. So we should have 3 wave pattern form over here. Right? It's very simple. So this is all under high probability strategy, and that is what we are learning. So thanks for watching, and I'll meet you in the next video. Bye.